Hi guys, welcome back to another video here at Trader Journey. I just wanted to make a quick video just explaining the basis as to how I select my expiration dates for contracts when I am options trading. This will mainly be a video for any new traders, however it can also help any experienced traders as well. So if you are any of those, stay tuned in this video and we will recap all of the details. So let's get straight into the video. So as you can see here guys, this is my Tastyworks platform, and this is the trading tab. So this is what you are essentially presented with. Generally this will be the same sort of layout which you would see in any sort of options trading platform, and what you're presented with here is all the different strike prices, and you have a sort of drop down list. Now depending on what platform you're using, you may see it as a curve, such as Tastyworks gives you a different option to see exactly how you want to be presented with the different types of contracts. You can actually see it as a curve, or you could actually see it as a table. I myself prefer to see it as a table, and it's better for me to sort of visualize exactly what I am trading and what contracts I am purchasing. So in today's video, as I mentioned, we will be covering off expiration dates, and expiration dates will vary hugely from 1 week all the way to years, months and years. And just as a sort of introduction, when you are doing different sort of types of trades, whether it's day trading, swing trading, you might be buying contracts as far out as a year, you need to take into consideration how much you're expecting the stock price, underlying stock price, to move in value. If you are expecting a stock price to move by $5 within 5 days, you would buy an expiration for a contract ending the same week. So it also depends on how fast and how much you're expecting a stock price to move by, which will then determine what sort of expiration date you will be looking to buy. Now, generally speaking guys, if you guys are day trading, I tend to always go for expiration dates of the current week ending that Friday, or the following week. I'll go as far out as 1 more week, but that's only if I'm looking to buy cheaper contracts. Now generally day trading, I will always go for same week expiration contracts, and if any of you beginner traders aren't aware, contracts always expire on a Friday. So you have weekly contracts which always expire on a Friday. So that's just something to keep in mind. So you always want to close any trades you're doing before that expiration date, or else you run the risk of that contract expiring worthless. So that's just something to keep in mind guys. So if you are day trading, I will 99% of the time always buy a contract expiring the same week, i.e. the Friday within the week. So that is what you should be keeping in mind if you are day trading. Now, alternatively, if you would be swing trading, if you are holding a contract for more than a few days or more than a week, you would then need to consider buying contracts the following week. I mean, most of this guys is common sense, and I think you guys will be fairly quick in picking this up, but you just need to ensure that the expiration date you pick is aligned with your trading strategy. So if you're day trading, you're buying contracts which expire soon. If you're swing trading, i.e. holding a contract for more than 3 or 4 days, or holding it for potentially weeks, you will need to select an expiration date that has enough time for that stock price to move and reach your target of the stock price, target price for the stock price. So you need to make sure you select the correct expiration date. So as you see in Tastyworks, makes it very simple for you. For instance, if you're swinging a contract, the date today is we're mid-September, but if we were looking to swing a stock, for instance, this particular stock is Apple. If you're expecting, for instance, the stock by the 1st of October or the 2nd of October to reach say $120, you would buy a contract hopefully expiring on the 2nd of October, which will allow you enough time to reach that profit target or that price target of the underlying stock. And you would generally pick a expiration date for that day, and you would obviously select the corresponding strike price. Now, I will make a separate video on the strike prices straight after this, and I will upload it straight afterwards. So if anyone's confused as to how to select the correct strike price, that will be followed shortly after this video. So I hope this kind of makes sense with the expiration dates of the contracts. But keep in mind, guys, if your contract expires, you run the risk of that contract expiring worthless, and it will expire worthless, and you won't have any of your initial investment of that contract back. So you have to keep in mind, you must sell the contract before it reaches that expiration date. So I mean, this is basically the basics of the expiration dates. Now some people might be aware of leaps. Now leaps are where you buy a contract that is 1 year out. So 1 year out, you would, for instance, with Apple, I have some leaps on the January 15th. They will generally be a lot more expensive, these contracts, because of the fact you have that time value factored within that contract price. So time value will make up a considerable amount of that contract price. So you will need to expect these contract prices to be a lot more expensive. So that is if you are not day trading or swing trading, you're expecting a stock to be a long-term position. That is when you would buy leaps, and leaps are essentially contracts with almost a year, or if not more, of an expiration date. So I think expiration dates are probably one of the most simple aspects of options trading, and I hope I've explained that in the simplest way possible for you guys. But if anyone has any questions on expiration dates, leave it in the comment section below, and I'll get back to every single one of you. And if anyone's confused on strike prices, I will follow up this video with a new video explaining exactly how I select my strike prices and why I select specific strike prices. But just before I end the video, guys, I do want to just talk briefly again on the expiration dates, and I'm just going to show you a graph which hopefully helps illustrate that a bit better for you. So this stock, again, I'm looking at Apple, and as you can see, you will be able to hopefully be able to ascertain how much a stock price moves on a daily basis. So for instance, if we were looking at Apple from 30th of July to the 3rd of August. Now, if you had, for example, swung this particular stock, and you bought an options contract, and you're expecting the stock to move by that amount of time that needed it for it to move that much, you would, for instance, in this particular scenario, you would potentially bought a contract on the 30th of July, and you probably thought, okay, fine, this is going to take at least a week for that stock price to move by that amount. So you need to think, how much time do I need on this contract for it to make that considerable move for you to lock in your profits? So for instance, for this example here, 30th of July to the 4th of August, it moved from around $95 to around $100, $110. That's a huge move. If you caught that would have been a huge amount of profit, but you need to keep in mind how much time do you need on the contract to make that profit. If you were day trading this on that particular day, 30th July, you would have had to buy a contract expiring on that Friday, and that's what we would do when we were day trading. But if we were swinging this over the next week, we would have to actually buy a week or 2 weeks out expiration date in order for that stock to have enough time to move and reach your profit target. So I mean, that's just in simple terms, and I think a graph helps illustrate what expiration date you would ideally need to be going. Now Apple right now is doing something interesting. It's kind of consolidating between this zone here. Now if you're expecting, depending on what your technical analysis is and what you're expecting of this stock, but say for instance, hypothetically speaking, you're expecting the stock to reach back to its all-time high, and you roughly thought maybe it would probably take a week or two before it reaches that all-time high again. If your strategy and your technical analysis has suggested your price may potentially reach and go up again, then you need to ensure that your expiration date of your contract allows enough time for the stock to move by that amount in order for you to hit your expected profit. So I mean, you have to keep in mind all of these potential factors: how much you expect the stock to move by, how fast does the stock move by, and how much time do you need on that contract for it to hit that expected price level. So I guess that's just the real basics of it. But as I mentioned, guys, earlier in the video, if anyone's got any questions, leave it in the comment section below and I'll get back to every single one of you. Just want to thank you all for watching as the channel is growing, and I will catch you all on the next video. Thanks so much for watching. Take care. Goodbye.